Hello, class. Let's welcome Ms. Sharon Moten to our real estate principles class. She's going to be talking about real estate finance, the home buying process, and if interested, she's going to also talk about how you get into the loan officer business. And I'll let her take it away so she could introduce herself and tell you guys about her background. Take it away, Ms. Sharon. I will be putting myself on mute. And welcome to Real Estate Principles.
Thank you for having me. I'm happy to share my journey through this real estate mortgage market industry. So my name is Sharon Moten. I've been originating mortgage loans for 24 years now. I actually started my career in retail. I started off as I went to school for fashion merchandising. And I spent the majority of my time in retail. And the latter of my career, I was a national makeup artist for Lancome Cosmetics. And the reason why I left in 1999 was because I got pregnant in 1996. And I had my daughter in 1996, sorry. And as you guys know, I don't know if you guys have ever worked retail, but it's very, very demanding in a different type of way. So it requires a lot of your time. So I wanted to do something a little bit different so that I can have more time, more energy with my daughter, because my ex-husband was between Seattle, Washington, and California. So she was with me the majority of the time. So a friend of mine had introduced me to a mortgage company. I knew nothing about it, but my best friend, her family was heavily into real estate. So like you guys, I decided, okay, well, let me take real estate principles. And I believe that's what you guys are taking now. So I went to college in West LA College in West LA. I went there and I studied real estate principles. And I went and I was pregnant, and you guys, I took my test, not to discourage anyone, but this is my journey. I took that test about 3 times and I just could not focus attention on passing it. So then I later consulted with a real estate broker, and she says, well, and this is the difference between real estate and mortgages. If you want to make money quicker, then you would maybe want to get into mortgage financing. If you wanted to make kind of not more money, but if you wanted a longer journey and you like selling houses, then you want to stick with real estate. And once a salesman, I believe you guys always a salesman. If you've ever sold anything from McDonald's to jeans to lipstick or whatever. I used to sell lipstick, Lancome lipstick for like $20 a tube. And back then I have to justify why would you pay $20 for a lipstick? But we sold it. So if you can sell anything, you can sell anything. That's the point I want to make. So I later became interested in the mortgage part of the business. So I had a friend that introduced me to this company called AmeriQuest, and I'm sure you guys are all young, and probably my daughter's age is 25, but they introduced me to this company called AmeriQuest. And at AmeriQuest, we were selling mortgage loans for like 13, 18%. So what you did there was we cold called a lot, and you try to get customers that needed to refinance their business or whatever, reterm their loan, and whatever rate they took, that we sold them. So I started off like a telemarketer kind of. I did not understand anything, you guys. I didn't understand what loan to value is, which you guys probably don't understand either. But a lot of the stuff I didn't understand. So to fast forward in my career, I later got into the banking part of it. And this is where you decide if you will need an MLS, or if you decide to go a different route, you do not need a mortgage license. A mortgage license is like having a real estate license. So you're kind of licensed you are licensed by the state. If you work for a bank like Wells Fargo or any bank, Chase or US Bank or whatever, they will sponsor your NMLS. So you don't have to get a state license, a separate license for that. That's only if you're going to be working for a direct lender or maybe a mortgage broker or for like a Loan Depot or a Rocket Pro Mortgage or something like that. So fast forward, I started my career with a company called World Savings that later became Wachovia, that is now Wells Fargo. So that's how the journey went. So I don't know if you guys, if Candace talked to you guys at all about what happened in 2007, 2006, when the real estate market crashed. If you guys are taking real estate principles, I'm sure he's probably touched on a little bit of the market and how chaotic it is now. So what I like to do is just kind of, so you guys can have a little bit of understanding about the mortgage financing, because there's a lot of moving parts to it. There's a lot of different programs for different people. So there's a lot of moving parts, but we're the backbone for you guys, for any real estate agent. Your loan officer is your backbone, and she's your key to that transaction if they are financing that transaction. So I want to take you back to when I started out. I started out as at the bank and Brentwood. I'm not sure if you guys are all familiar with Brentwood. If you are, then you know the area I'm talking about. So I started and didn't know anything, you guys. I swear, I was winging it. I started in at this bank, Wells Tall Bank. I don't know if you guys are familiar with San Vicente and that tall building that is now Wells Fargo. It used to be World Savings. I started there as a bank loan officer, and customers would come in, you know, from the bank, and that's easy because the bank tellers would refer you to the customers that came in if they needed a loan, if they needed to purchase. Purchase means they're going to buy a property, or if they needed to refinance. Refinance means they're either going to return the loan to a lower payment, or they're going to take equity cash out of their property and invest and do whatever they need to do. So those are the two options. So I started there, and you guys, I was doing very well. I was learning as I was going, really learning and understanding what loan to value is. And I still didn't have a good grab of it, but I was learning. So I said, you know what? I sat there in that bank for like 2 years. And after 911, and I don't know if you guys are old enough to even live through that experience, I did. That was 2001. And I can remember because that's when I changed from a banking to become an account executive for World Savings. And that's when 911 happened. So when 911 happened, you guys all know what 911 was. When that happened, the rates had went bottom low. So 911 happened and the rates had all dropped to like 2 and the 3s, low 3%. So then the market became chaotic. So I said, you know what? I can go independent and be an account executive for World Savings. And it's not independent, but it's just like you're self-generating your own income, but you're still working for that company. So I did that. And that was the best time in my life, because when you're an account executive and you're working for a lender, you're assisting loan officers in that particular broker's office. So I'm the key to the loan officer's success now. I become their shoulder to lean on, or whatever, to give them information, to close their loans or whatever, to give them product. So I had about over 50 accounts when I was doing it. And back then the market was just like, it was one big party, you guys. I don't know if you're the disaster that happened later, but everybody at that time was making money. And at that time we were doing loans for people that worked at McDonald's, managers where they were making $60,000 a year. So all you have to do is sneeze and you can get a loan, literally. So we didn't really look at it. We did, if it makes sense, then we'll do the loan. We didn't really look at your FICO score. If your FICO score was like in the 500s or whatever, we said, well, if he's doing this and if you have this much money, and if every other aspect of that loan made sense, then we would write that loan. So we're just writing loans and people were buying property. Everybody, real estate agents were making money, appraisers were making money. Everybody involved in mortgages and real estate was making money because there was a lot of stuff going on in the back end too. But I didn't know about any of that until later on, and I'll get to that part later. But everybody was making money. So then here comes, and then I bought my condo in 2007. So here comes 2007. And what happens? So I'm in my office in Woodland Hills, California. And at this time, World Savings had bought out and sold to a bank called Wachovia, which later became Chase. So we got a phone call on the East Coast and they're like, oh, that whole division just got fired. And we're like, oh, it's not gonna happen to us. It's not gonna happen to us. And so it was like a snowball effect. So they got the call and then we got the call, and the whole market at that time, everyone was laid off. At that time, the market just collapsed. The stock market collapsed, the mortgage market collapsed, the real estate market collapsed. We had a financial collapse. I'm sure you guys heard of the recession that we had in 2008. I'm sure Ken talked about that. But that's when we had the collapse of the financial institute, and people lost their homes. The property values became more than what the property was worth. So then we had to do a thing called short sales. So I said, okay, I took 2 years off just to get myself together and just to take time away from the market. I took 2 years off, and then I decided that, the big market then was loan modifications, was to help people bail out from their situation, or short sales. So I said, let me get into short sales. So I went to work for short sales with Bank of America, which took over Countrywide, which was the #1 subprime lender at that time. And they were the biggest ones with all the foreclosures and all that with the short sales. So I went to work on their escalation team to be a negotiating rep for short sales, escalation. So basically when you're doing that, we're short selling all these properties. So people are like, literally, you guys, this was the most hardest part of my job. People were like literally committing suicide at that time. Praying, people that never prayed before prayed. I must have prayed with so many people that didn't know God. People were, grown men were crying. It was very, very dark back then. Almost kind of like with COVID, but a different kind of darkness. Very dark. So I got through that. We short sold, helped a lot of people, did a lot of modifications, and modifications are when you just reterm the loan like to a lower rate to prevent any foreclosures. So 2007, I was saying, was when I bought my condo. And I had, at that time, I had 100% loan. I had an 80% first or 20%. I didn't put any money down. Only thing I did was paid for the closing costs when I bought my house. So here comes the crash, right? I bought my house for $410,000. So when the crash, but brand new condos that they built in 2007. So when the crash came, my property became worth like almost like 200,000, and I owed 410,000, right? So I was like, whoa. So I was never looking when I bought my property, and you guys may want to remember this as well when you're going into real estate or whatever way you want to go, is you look at your property. I looked at property as an investment. So I never bought my property to use it as a cash machine to cash out or whatever, unless I had a dire straight emergency, which I haven't. So I didn't use it at that. So to make a long story short, my mortgage lender Chase ended up modifying my loan. They took like 140,000 off of my principal balance. They forgave my second, and here we are today in a different market, and my house is worth more than what I bought it for in 2007. So if we fast forward today, what's going on in the industry versus what went on in 2006, 2007, when the market crashed, and we're in a different market. So give me thumbs up if you guys have heard about bubble, a real estate market crash. What are you hearing on the streets? Give me thumbs up if that's what the talk that you're hearing out there. If not, then I'll explain it to you. So I don't see any thumbs up. So what happened, what you're hearing now, you may be hearing now from some media outlets, is that, oh my God, we're gonna have another crash like we did in 2007, when the real estate and the financial market crashed. Now, the reason why it's different is it's economics. And I'm sure you guys are learning that through principles and all that, or you will learn it later. It's economics. So what happened in 2007 was a financial crash. What happened with COVID in 2020 was a forced recession, meaning that they had to force us to leave our jobs. They had to force us to stay at home because we had this pandemic that consumed the world. Nobody knew anything about it or whatever. But for us, it became one of the, and for realtors, it became one of the busiest times. So whenever there's a recession or something, it becomes it's almost like the haves and the have-nots. It becomes a busy time for certain careers, or certain businesses become very busy. So to say that is, the media is now saying, because we have so much appreciation, which means that the property is worth 300,000. Next month it's worth 315. Next month it's worth 320. So maybe it's appreciating by 5% every single month. And when I say appreciation, that means that you're gaining money in that property. You're getting equity, what we call equity. Equity means, look at equity as I'm getting money. I'm either gonna get money with my equity or I'm gonna lose money with my equity. And if I tap into my equity, which means I'm either gonna take cash out or I'm gonna reterm or whatever, I may lose a little bit of my equity. Or depending on how much I cash out, I may lose up to 75%, 25% of my equity or whatever. So what was my point for saying that? Oh, so the reason why they're saying, oh, there's gonna be a bubble, is because this is what happened before the real estate market crash, is because they're seeing homes appreciate like faster than they've ever done ever. And they're seeing bidding wars. So bidding wars, a few months ago, I was in so many bidding wars. I talked to so many listing agents to fight for my customers. It's like you see a property that you want, say for 400,000, right? And then somebody else comes in and they see that same house and they're like, we'll bid 410,000. So the seller's saying, oh, they're bidding higher. And then somebody comes in and they'll say, no, we'll take 410, 500. So it's almost like you're auctioning, right? So the seller's mind, and I'm sure if you guys were a seller, if you own real estate, your mind is to take the best and the highest, right? So that's what was happening. By doing that, they were setting the tone for the market. They were setting the home prices for the market. So let's say that house, if you looked it up on Zillow, let's say they were marketing it for 600,000. Okay, and then let's say that they went into multiple offers. When I say multiple offers, that means that they had maybe 10 to 20 bids on that property. That means they had that many people putting offers on that one house. And this was what's happening a few months ago on that one house. So let's say, okay, Mr. Joe says, okay, I'm gonna take the offer for 620. So by them taking that 620,000 offer, guess what they did? They just appreciated the neighborhood, right? So now my house, if it's like that house, is going to be worth 620, even though yesterday it was worth 610. Okay, you guys have any questions? So that's what's happening. So now the reason why you're not going to see a bubble is because I'm going to give you an example about what's going on with the housing market today and why there's a difference. So in 2006, let's say the average home price was 300,000, right? And let's say we gave you and back then we were selling mortgage interest rates, meaning the rates that you're going to pay on your house at 6%. Let's just say average. Some brokers were selling higher because the higher they sold the rate, the more money they made back then. So let's say they set the rate at 6%. Your monthly mortgage payment, which means like your rent payment, is $1,800. Every month you have to pay $1,800. The average household income in 2006 was $6,000. That's the average. That's the average income. If you were to combine everyone's income, the average was 6,000. That's a 55% increase. The monthly money that they were spending on their debt to income, that means the amount of money you bring home and that you're going to spend on your house, your mortgage payment only your mortgage payment. They were using 30% in 2006. They were using 30% of that income to pay that mortgage. Now let's fast forward to 2021, okay? Let's take a house because we know there's no $300,000 houses in LA. Let's take an average home price of $423,000 today, right? And there's not even really anything, but we're going to use this as an example. The average rate is 3%. So you're almost cutting that rate in half. And you're also increasing the home price, and this is not the purchase price, this is the loan amount. I'm going to back up and say these are the loan amounts. So you're increasing the loan amount by $123,000 at a 3% rate. Your monthly mortgage payment, you guys, is $1,783. Okay, so excuse if you hear sirens. I live right next door across the street from a fire station, and they're like the number 6 fire station. But anyway, that's a $20 difference in 2021, right? So we're up. So the average household income in 2021 has gone up 55% to $9,300. From $6,000 in 2006 to $9,300 to 2021. That's just the average. And guess how much you're using to service that $423,000 loan? You're only using 19% of your income to service that monthly payment. So how can there possibly be a housing bubble? If you look at the economics of what's going on, you look at the economy, you look at the demand, there's still a lot of pent-up demand for housing. As long as you have the demand, then there cannot be a bubble. And even if somebody said, oh my God, I lost my job, I'm losing everything, I have to get out of this house or whatever, let's say they wanted to sell. They're going to make a couple of $100,000 on that house where they can redo their life and start over. Versus back then, when we had the financial collapse, you had no equity to get out of anything. We had to bail you out. The government had to bail you out. And back then, the government was bailing everybody out with that couldn't pay their mortgage or couldn't sell their home or kind of just stuck. But today, if that was to happen, you can sell your home and make a lot of money and just relocate where it's affordable for you. Okay, so that's the difference. If you guys hear, and you guys can kind of get one up, I don't know where you are in your studies, and say, no, there's not going to be, there can't be a bubble. Or if you have friends or you know people that are thinking, oh my God, I should sell, I should move. No, there's not a bubble. We're still getting appreciation. Properties are still gaining equity every day, every month. Somebody is selling and equity and homes are appreciating. And then the last thing I want to talk about It's just like the different programs that are out there that you guys may have heard of, and one of them's FHA. FHA is the Federal Housing Administration, and what FHA does is it helps people, first-time home buyers get into homes with only 3.5% down. Or today we have 100% where we have, it's like a down payment assistance where we'll give you a silent second to get into that home. That's for first-time home buyers. Then you have your conforming, which are for, those are the investors for those, I'm sure you've heard are Freddie and Fannie. Those are conforming, and those are the minimum down payment for those are 3%, depending on how much your purchase is. And then you have your jumbo loans, which are like your $1 million estates, anything over, they just increased the limits, but I don't have them yet. Anything over, let's just say 850,000 is when you're into a non-conventional jumbo loan. So just know what it is you want to do, where it is you want to go. And my suggestion to you, because honestly, I've been in this business for 24 years, but every day I'm learning something. Every day is a learning experience. Every day I'm meeting people. And before COVID, I would go to open house at least every Tuesday and Friday. I was at a broker opening. So I was meeting people like you guys that want to be like that. So I was going to your openings. I was giving water, participating, talking to potential homeowners, agents, but that's how I network. So every Tuesday and Friday, that was my hustle. And then every Saturday or Sunday, I made it a point to hit at least 3 to 6 open houses, just because I wanted to build a territory. So in my area, I'm in the San Fernando Valley. I'm in North Hollywood. I'm Studio City, Ventura, Sherman Oaks. I'm all the way over here, Toluca Lake. So when people see me, hey, that's Sharon. I do mortgage loans. So when you're branding yourself, you want to focus on one thing, not 2 things. It's like I was telling someone, I want to get my real estate license, and they made sense. And they're like, well, that'll take away from your mortgage business. So I had to figure with my career, do I want to sell houses, or do I want to continue to help people get into homes? And I figure my mission is to help people get into homes, to go that route. So you may find that you don't want to do real estate. You may find that you don't want to be a mortgage loan officer. You may find you want to be a processor or an assistant or a CEO. This world is your oyster. But if you're into real estate principles, there's something that guided you to go, like me, that took you to go to those classes. So you're one step foot into the door. So my thing to you, it's not easy once you get that real estate license, but it's a heck of a lot of fun. And if you have a passion for it, if you believe in yourself and know you can do it, you can make a lot of money, whether you're in it for 3 months or rather you're in it for 10 years. Some rookies that have been in it for a few months are doing better than people that have been in it for 30 years. And that goes the same in my business. There are people that have been doing it for a few months that are having major success. There are people that are they're doing it for 30 years, 24 years or whatever. They're having minimal success. It's the same thing. It's what your heart desires. But I got to tell you guys, if you don't have a heart for it and you can't do it, and you can't do it part-time, and I'm going to tell you, if you want, you can do it part-time. There's a lot of part-time realtors out there, but that's what they are. They're part-time. If you don't want to do it, if you want to do it part-time, then just know that you're going to make part-time money. Or you can do it part-time, but make real estate full-time and make your part-time, if that makes sense, if you need some type of revenue coming in. But once you get on a roll and once you decide what's going to be my customer base, the world is going to open up for you, because it's only getting bigger and it's only getting better. So we're gonna have ups, and yeah, we're gonna have downs. We're going through a little correction now, but it's not a bubble correction. It's like maybe somebody's gonna sell their house $10,000 less, and they should, because we're overpriced anyway. So you're gonna have ups and you're gonna have downs, but if I can leave you with one thing, have a passion if you're gonna get into this business. And if you have that passion will lead you to success like you've never imagined. And if you're starting out young, I don't know what the ages are on here, then the world, like I tell my daughter, the world is your oyster. You have the opportunity to take your real estate career wherever you want it to go. And now we will open it up for questions and answers.
Sharon, do you mind covering in terms of like the home buying process and what students would need to know in terms of how that home buying process works for
Sure.
especially in regards to their credit and what you're looking for and how to
Sure.
yeah, please.
So okay, so let's say you guys are realtors and let's say anybody wants to buy a house. The first thing you want to do before you even look for a realtor or before anybody wastes your time or shop, you want to get them pre-approved at the bank. That means they have to go through me or a bank or whatever to get a pre-approval letter. That means we've looked at their income, we've looked at their credit, we've looked at their financials, their W-2s or their tax returns or whatever they're using to pay. And we say, okay, Mr. Roger, you qualify for 800,000 or whatever. So when it comes to FICO score, there's two things. So FHA is not FICO score driven. So you can have a less than perfect score, meaning you can have a minimum FICO score of 580. Some lenders, I'm a broker, so some lenders will take a minimum FICO score of 500. But with that low FICO score, below 620 is our magic number. So anything below 620 will go for an FHA home buyer, right? So they either have to sacrifice that FICO score, they either have to be heavy, have more in reserves or more closing costs in order for them to go up to a certain debt to income limit of 50%. So for an FHA home buyer, you guys, they're not FICO score driven. Now, when it becomes FICO score driven is when we're going into conventional loans. And those are the loans that we're selling to Fannie Mae and Freddie Mac. Those are the two largest investors in the world. So for those two loans, the banks require a minimum FICO score of 620. So you have to have a 620 in order for Fannie Mae and Freddie Mac to even look at you. And if you're going into the bigger loans, like the luxury stuff, they're usually looking for a minimum FICO score of 680. And you usually have to put a bigger down payment. So let's back up to the down payments. For an FHA loan, you can either you can go with the down payment assistance, which requires your FICO score to be 645. So the more lenient the program, the higher the FICO score, right? So if we're giving you a down payment assistance, if we're assisting you with that down payment, we want you to have a 645, at least a 645 FICO score. And there's other buckets that you have to check off. But if you're just going in with the basic FHA loan, first time home buyer loan, where your FICO score is 580, and you just want to put the minimum 3.5% down, then that option is out there for you as well. When you get into conforming has a minimum down payment of actually 3%. So with that, you guys, anything below 20, like if you're putting a down payment of 3 or 3.5, you're going to have something called mortgage insurance. And I don't want to get heavily into it because I don't want to confuse, but mortgage insurance protects, like FHA, it protects the government in case you guys default on that mortgage and that your client can't make that mortgage payment. So that's where private mortgage insurance comes into play with anything that is below 20% unless you structure it a different way. So that's the first thing you guys want to do is before anybody says, hey, I want to, or look for a house, you're going to ask, the first question you're going to ask you guys is, have you been pre-approved by the bank? And no, I haven't. So maybe you have a preferred lender, or maybe you'll tell them to go to their banking institution and get pre-approved for the house that they want to purchase. And then sometimes as realtors, you guys you're gonna get happy and lucky and get an all cash buyer where you don't have to do anything with the bank. You're just working with an escrow company, and you're just sourcing the funds of where they got that cash. You guys have any questions? Okay, Kendrick.
Yeah, I was just wondering, can you also talk about like the credit 101, like what the do's and don'ts of credit, especially in the middle of a loan process?
Yes.
That's possible.
Okay. So if you're in let's say you're getting ready to buy your home, and we're in the process, we're in underwriting or whatever, right? So as a lender, we check the credit up front, right? So you have your car payment, you may have this, you may have a credit card here or whatever. So when you're in any type of transaction, whether it's a refinance or whether it's a new purchase, what you don't want to do with your credit is you don't want to go out and purchase a new car or get a new line or get a student loan or anything while you're in the process of the mortgage. And then another thing is you don't want to do, if you know you're going to purchase a home, is you want to make sure that your debt to income is going to support whatever your dream house is. So if you know you're carrying $30,000 worth of debt, right? And unless you're making lots and lots of money, then you're okay. But if you're not making lots and lots of money, then you know you may have to pay off some debt in order to qualify. Because the banks will look at how much debt you're carrying versus how much income you're making. So a lot of people will either refinance or whatever to get out of that debt, or they will slowly pay it off. So we basically look at those type of things on a credit for a first-time home buyer. We kind of used to look at 3 trade lines, but we use alternative credit now. If you have, like if it's an FHA, we may ask you for your gas bill or your light bill or something to show that you have the ability to pay on something. So it is important to kind of build your credit when you're thinking about buying a home. Or another thing you can do is, if you don't have credit, is that you can get a co-borrower, and we call them a non-occupant buyer, but they're essentially a co-borrower. So, but they're not living with you, but they're helping you with the income of that loan. And if you go that way, then you have to know that we're also going to look at their debt, their credit, and their whole profile to make sure that they can qualify along with you. Is that what you wanted to know, Kendrick?
Yeah, that was perfect.
Mhm.
Okay.